Salute, folks. It's your boy, the insurance junkie, your fiduciary fella, the all-star advisor Alonzo Hall, your social media insurance bro. Back again today to whap and tap on your head with another ADH Wealth Solution article. Today's article is about the buy, borrow, die strategy. It's an article written by David B. Mandel, JDMBA, and Carol Foose, a CPA. It was also fact checked by Susan Rapp, written October 17th, 2022. Avoid capital gains taxes like a billionaire using the buy, borrow, die strategy. I've talked to you guys about this in the past. When you Google it, most of the time they won't talk about the best way to use buy, borrow, die, which is life insurance. We're going to look at what the wealthy do. Make sure to hit that like, drop a comment, subscribe, and hit that notification bell so you're made aware every time I release new content. And as always, share. Lastly, to contribute to channel growth or to schedule an appointment with a licensed financial professional, the links are in the description of this video. So often after speaking about taxes at a medical conference, we're approached by physician attendees who have read that billionaires like Warren Buffett and Elon Musk pay less taxes than they do, and they wonder how that can be. Typically, physicians then ask how they can do what the super rich do in this regard. In this article, we examine the buy, borrow, die strategy that billionaires use to avoid capital gains taxes and explain tactics physicians can use to do the same thing, or average Americans. The name of this strategy comes from this quote from Edward McCaffrey, who is a University of Southern California law professor. Once you're already rich, it's simple, it's easy. Just buy, borrow, die. These are planks of the law that have been in place for 100 years. We will examine each piece of the strategy briefly and discuss 4 ways that physicians can also make use of the strategy. Buy. For many billionaires, this means create startups that have huge companies. However, for physicians, this can also mean save and invest. Any action that creates assets on your balance sheet will work. Once you have an asset, you can then move to the next step. Borrow. This simply means borrowing funds using the asset as collateral. Loan proceeds have never been taxable under our tax code. By borrowing, you can get access to cash without paying any tax. As an example, let's assume Dr. Dave bought a stock 5 years ago for $100 and it grew to be worth $1,000 today. If Dr. Dave wanted to sell it, he would pay federal long-term capital gains on $900 plus state income taxes. When Dr. Dave needs some cash for another investment but doesn't want to sell the stock or incur any taxes, he borrows $300 against the stock to make the new investment. Die. Under our tax code, heirs get a stepped-up basis when they inherit an asset. An asset's basis is the amount that was originally paid for that asset. Basis is not taxed. Back to the case of Dr. Dave. Let's assume he never sells his stock, holding it until his death, at which time it's worth $5,000. If Dave leaves the stock to his heirs, their cost basis is stepped up to $5,000, which is the value of the stock at the date of his death. Thus, the heirs could sell it the next day for $5,000 and pay nothing in taxes. In this way, capital gains taxes have been permanently avoided on the $4,900 gain, or 98% of the value. You may wonder about the loan of $300 that Dave took. In this case, Dave had flexibility while he was alive. Maybe the investment did well and he paid off the loan in full. Perhaps he kept paying interest and the $300 principal was still due. Perhaps the loan amortized and a balance remained. In these 2 cases, the heirs could just sell a small fraction of the $5,000 stock to pay off the loan, and they would not pay any tax on the proceeds up to $5,000. In fact, if you multiply the value of stock by 100, 1,000, 10,000, or more, the lender may be happy to roll over the loan to the heirs for years or decades. This happens every day. Using the buy, borrow, die strategy. Let's examine 4 ways physicians can use this strategy in their daily financial lives. Second mortgages like HELOCs. This concept is simple. Rather than selling an asset to pay a large expense or make an investment, you borrow such funds from your home value through a second mortgage or home equity line of credit. Physicians do this often when making a down payment for a second home, spending on large improvements on an existing home, or paying a large tuition bill. Once the funds are borrowed, like Dr. Dave mentioned earlier, you have flexibility. You could pay down the loans, if that makes sense with your financial plan, or you might finally pay the loans off when selling the home as part of retirement downsizing. You could even keep the loans in place until death or beyond, as your heirs might have the right under federal law to keep the loan running if it is on a primary home. Portfolio loans. In this option, the concept is the same as was just discussed, except an investment portfolio is used as collateral instead of a home, and no assets need to be sold taxably to access cash. In fact, this is often what billionaires do. Take loans against their company stock. Elon Musk does this all the time. See the references that follow for more information on Elon Musk and Fred Smith using this tactic. In recent years, with interest rates being low in general and portfolio loan rates often being even lower than mortgage rate, portfolio loans have been extremely popular. As an example, Goldman Sachs was recently quoted as expecting its lending business on such loans to hit $10 billion, as the wealthy take out loans to cover taxes and all cash real estate offers. Certainly, it's not just the wealthy to have the access to such loans, with lenders offering loans on portfolios with balances below $500,000. Also, as with home loans, physicians will have flexibility in how quickly they pay off portfolio loans, or whether they keep these until death. In speaking with one large portfolio lender, they said they work with an estate when the client has passed away and often end up renewing the loan with heirs as long as the portfolio stays in place. Cash value life insurance. In other articles and in our book, Wealth Planning for the Modern Physician, we delve in more detail into the concept of permanent life insurance, also called cash value life insurance. Unlike term insurance, permanent policies have a cash value, which is a financial asset value that can be borrowed against using the same buy, borrow, die concepts as the first two techniques. For many reasons, however, cash value life insurance is the ideal tool for implementing this strategy. First, the cash values within the life insurance policy grow tax-free. In this way, these are tax efficient in the accumulation phase in a way that portfolios may not enjoy. Second, the loan rates on cash value loans can be contractually fixed when one purchases the policy initially. For example, suppose one such insurance policy has a contractually guaranteed 0.25% loan rate for the life of the policy. This means the policy owner will enjoy a near zero loan rate to borrow against their cash values, whether they do so in 1 year, 10 years, or 40 years. This is vastly superior to loan terms on HELOCs, second mortgages, and portfolio loans. Third, the death benefit of the life insurance policy is the very mechanism used to pay back the loan principal. In this way, the life product itself is designed to pay back the loan efficiently, and the owner/borrower does not need to worry about other assets to pay it off. Let's look at an example. Let's revisit Dr. Dave and assume he has invested $20,000 per year into a cash value life policy and now has $300,000 of cash value, and the policy death benefit is $1.5 million. If Dr. Dave needs $100,000, he can simply borrow it from the policy tax-free, choose to pay the contractually guaranteed interest rate from outside funds or from the policy cash values, meaning nothing out of pocket. When he dies, if the $100,000 principal is outstanding, the death benefit will be used to pay that loan balance off first and then remit to his beneficiaries. In this example, his heirs would simply get $1.4 million and the $100,000 will go to extinguish the loan. In this way, the tax-free loan for his current cash need and the efficient loan payoff were both accomplished with the cash value life policy. We're not even going to look into premium finance, ladies and gentlemen, because you aren't ready for that. Wipe ass. Work in progress every day and see success. Salute.